Hello, everybody, and welcome to another episode of the Amicable Divorce Network podcast. I'm your host, Tracy Moore-Grant, and I am the founder of the Amicable Divorce Network. If you've been joining us for season 2 of the podcast, you know that we are going chapter by chapter through our new book, Divorce Amicably, Your Roadmap to Resolution. This book is available on Amazon in hardback, paperback, and Kindle version if you don't want anybody to know that you're reading about a divorce. And we have made it all the way to chapter 55. And this is a very important chapter today because it deals with the marital home, future home purchases, and people have so many misconceptions about financing, mortgages, real estate, and divorce. And so I'm joined today by two of our top network experts, Jennifer Brown and Tami Wollensak, and they are both divorce mortgage specialists. Yes, that is a thing. If you're going through a divorce, you need a divorce mortgage specialist. Just like if you're having a heart attack, you would need a cardiologist. So I always try to point people to the best professional for their situation, and two of the best are with me here today. Welcome, Jennifer and Tami.
Thank you so much for having me.
Good to be here. Thank you.
Let's jump right in. And I know that you guys deal with calls all day long from people going through divorce or divorce attorneys asking all kinds of questions. And so Jennifer, to you first, right out of the gate, what is your top tip that you would give somebody going through a divorce that you want everybody to follow, you'd like for them to know?
Well, you know, in the state that we're in right now with so many people with sub 4% interest rates, I would probably say that just because your current mortgage doesn't have a legal assumption component doesn't mean that an assumption may not be an option for you, because it might. However, there are a lot of things that have to fall into place for that to happen. So that would be, I think, the number one thing is don't just assume that you have to give up that financing, because if you can situate things properly, you may put yourself in a position where you can assume that conventional 30-year fixed mortgage.
And explain to people listening what an assumption is. I think there's a lot of misconceptions about what that process is even like and what it is.
Well, a qualified mortgage assumption is basically like going through the mortgage approval process again. It essentially is you make loan application, you're going to have your credit pulled, you have to submit your income documents, all of those things are going to be analyzed by an underwriter, you have to meet all of the guidelines. And when you have a legal assumption component like FHA, VA, USDA, conventional ARMs, the servicer does have to allow you to assume the mortgage if you meet the guidelines. On a conventional 30-year fix where there's no legal assumption component, they are not required to, but they can consider it. So it's essentially at their discretion.
So just playing devil's advocate, I assume that banks lose money on assumptions because they want people to refi for a higher interest rate. So what would their motivation be to allow people to assume?
Well, not to get into the weeds, but not necessarily, because mortgage servicers typically do not start making money on a mortgage until they've serviced it for at least 4 years. So they're not actually turning a profit on that until year 5. So what I am seeing in those situations where one party is awarded all of the equity or they're able to trade some other assets, we are seeing people have success having assumptions approved. So it's not as if the servicers don't want to do it. But there are a lot of things that have to fall into place, right? And so not everybody is going to be a candidate for it. But when you are, it is definitely something that you should pursue.
Because you get to keep that very desirable interest rate. I know everybody is so interested in that these days. I hear that in every single case. Tami,
right.
What's your top tip that you want people to know going through a divorce?
I think it's really important, and thanks for that, Tracy. I think it's really important for clients to be empowered to make this decision, because there's so many nuances around it, is to meet with somebody early to plan and know exactly what they're signing up for and to know exactly what they're giving up in all different scenarios so that they can make a better informed decision regarding sometimes one of their biggest assets.
Yeah, I absolutely agree. I'm a mediator, and in Georgia, I don't talk to the parties beforehand, and so many times I walk into a mediation and somebody's talking about buying out the other person or doing something with the mortgage, and I'll say, oh, have you qualified for that? Is that approved? And they have not made even an inquiry, so they could be signing up for a legally binding document without having even filled out a form or called one of you guys to figure out if that's possible. please contact somebody early, and especially before you sign a legal document at a minimum, not after. One of you guys' top tips was understanding property, title, and ownership. Jennifer, do you want to tell us about that?
Tami, take that one. That was her part of the
Tami?
chapter that she wrote.
As far as mortgage guidelines are concerned, it makes a difference from a legal standpoint on who is on title, and there's a lot of complexities to that as far as the terms of the loan that you will get post divorce if you're not on title. It doesn't mean that you don't necessarily have ownership of the house if you've lived in the house and it's a marital property, but sometimes we do see where somebody is not physically on the title of the home, and so it's important to have that looked at prior to making these decisions too, because it can change the terms of the loan.
Okay, very good to know.
Also, I would add to that, and Tami, I know you would agree that sometimes we see situations where one party agrees to stay on the mortgage so that they can preserve those terms because they know it's a contingent liability, but then they remove themselves from the deed.
Oh, right.
And
Yeah.
so we always say, you really need to talk to your attorney about that. It's probably not a very good idea.
So if you're listening to this and you have no idea what Jennifer and Tami are talking about because it's way over your head, like sometimes it's over my head, this is your first clue that you need to call Jennifer and or Tami to help you, as well as a lawyer, because a lot of people we see making what I would call DIY mistakes. They do an agreement themselves, they don't investigate, they don't talk to the right people, and then they're stuck in this legally binding agreement and they have really no idea.
I also say, Tracy, that because you are so good at what you do and you do understand that there are attorneys across the country, because I do talk to people across the country whose attorney thinks they can give this guidance, and that is wrong. And if your attorney is giving you guidance as to what to do with your marital home, run.
Yeah.
Because I do not think that is not their lane, and that is obviously not, they're not trained to do that.
Yeah, lawyers are not supposed to be giving mortgage advice, financial advice. They can point you to a person, and you can find Jennifer and Tami on our website to get your questions answered. But if you're negotiating a refinance or equity buyout, anything like that, you need to make these inquiries first and inquire with the proper professional. I always tell my clients, do not walk into your bank and talk to the mortgage person that's sitting there, and there's nothing against that person, but this is a very specialized process. So you need to talk to a specialist to get you through the divorce and make sure that you're talking with the right person, because the knowledge that you guys have exceeds, and the training, a standard mortgage professional. It's for divorce.
Right.
And so one of the things I think that people don't understand that you guys do, and attorneys don't often, I see this a lot, is the support income and impact on mortgage qualifications. And we talk about support, we're talking about alimony, and we're talking about child support. Who wants to take this one?
Well, I think we can both talk about it a little bit, Tami. What do you think?
Yeah. Well, go, you start.
So it's probably the number one Achilles heel that we run into when we are late to the party, meaning settlement agreement is finalized. Let's say that they have agreed to do an equity buyout and they do have to finance it, so refinance is going to be in order, and they need support income to qualify, but the support is not going to continue long enough to meet the continuance requirements. So that's probably the biggest thing, where you've got a kid aging out, so they'll turn 18 before the 36-month continuance, or it's alimony, which we see that a lot, being like 12 months. What's your experience with that, Tami?
All the time. It happens all the time. Or in in the final documents, it says that the spouse is to refinance within 90 days and they're receiving support income as maybe even just part of their income, but we need it in order to qualify them. They may have a job, they may have stable income, but not enough income to do what they're setting out to do. And if it says 90 days, then we're really pigeonholed into just a couple different products that we can do, and it may not be the best product for them.
And I had a situation I reflect on a lot. Jennifer was involved in this, and she probably doesn't even remember this, but it really stood out to me, where I had a client where they met with Jennifer first, they did all the right things, and when she ran the numbers, she had determined they need $13 more in support, because the guidelines are sort of black and white, like you meet the guidelines or you don't. And it was like, if you got $13 more a month, that would push you over this, threshold. And she wrote a letter about that, which we took to mediation, and the other person was happy to sign up for $13 more of support to meet the goals overall. And so that was just a very easy fix there, but it really illustrated to me how such a small amount can be the difference, and having a specialist look at that before you make those decisions is really important.
Yeah. Sometimes you can just break down that same bucket of money and extend it out for just a little bit longer period of time in order to meet the obligations as well. And, it's not that somebody is getting anything less, they're just getting it for a little bit longer of a term to meet mortgage qualification guidelines.
Yeah, I think it's fundamental to understand. People will ask me, legally, can we do this? What you can do legally, as we're talking about here, you can put almost anything in a legal document. That does not mean that it meets mortgage guidelines. So just because you put it in your settlement agreement doesn't mean a mortgage company is going to accept those terms and help you meet your goals. It could be quite the opposite without the proper help and guidance. So a lot of people going through a divorce, somebody might be returning to the workforce. And how does that impact mortgage financing?
That is a slippery slope because it really depends. It depends on the loan product. It depends on what they did prior to exiting the workforce. Can we document that they had a 2-year history prior to leaving? Did they go to school and learn a new skill? So now maybe they're a nurse, but before they were a paralegal. So there's a lot of nuances to that. And so we do want to talk with someone and coach them up first. And the number one thing I tell them is do not take any position that is not a base salary, because consistent and stable is the word of the day. Don't start your own business. Don't go to work earning commissions. Don't take an hourly position that's going to be variable income. It needs to be the same payment every single month. You're going to have a much better chance of being able to close on something right away than you would if you take a variable income job. What do you think, Tami?
I think that's absolutely true, because a lot of times people, after they're going through a divorce, they may think that whatever money is going in their bank account that we can use, but there's very rigid, strict guidelines on how that income source can be used for qualified income. And so we have to make sure that it's stable and consistent, and a salary is a great way to do it, even if you're only planning on being on salary for a little bit of time. And then maybe you want to start your own business down the road or something, making sure that you understand what it takes to meet the goals and to meet the obligations of what you had agreed to is going to be really important. And sometimes that is the way that you're getting paid. Unfortunately, we look at all that.
So the next topic we have is contingent liabilities and debt obligations. And I think this is a really complicated topic for people to wrap their head around and understand how that impacts their ability to get a mortgage. Jennifer, what is a contingent liability?
Well, a contingent liability basically means it's been court ordered to someone else, and court ordered debts are not counted against you in your debt to income ratio. And I think that is definitely one of the things that you just blow people's mind when you tell them that. I mean, they don't believe you. I have to cut and paste the guideline from Fannie Mae sometimes and email it out to the other attorney so that they can see that is the guideline. Obviously, this is a high trust situation. And so that would always be, I think, our disclaimer is that, yes, you can remain on the mortgage. If it's assigned to the retaining spouse, then it's not going to be counted against you. But you obviously have to trust that the person who's assigned the debt is actually going to make the payment.
Yeah.
Because if they don't, then it's going to ruin your credit and have an adverse effect on your ability to qualify.
Yeah, so what you're touching on is somebody's court order to pay a debt or an obligation. That does not get considered by mortgage guidelines. However, nothing's going to protect you from your Equifax credit score if they're making that late or not at all. So those are, again, two different things that people don't think about. They think about really just the credit score, but there's two different things here, and having it in your agreement doesn't mean Equifax is going to take it off your credit.
That's right. The only way to have it off your credit is to refinance it, sell it, or someone does a qualified assumption with a release of liability.
So what other debt considerations should people think about when approaching settlement in their case?
Tammy, you want to take that?
Yeah, for sure. I think that people need to be very clear, and that's why planning comes into play, because we can look at your debt, and look at what all of the obligations are on your credit report, and then we can go through it. And the more specific it is in your settlement agreement, the more clearly it's going to be post-divorce for any lender. If it's spelled out specifically with even a truncated account number, then we know that we can remove it, and it's going to make for a smoother process post-divorce.
I think student loans are a big one that we see missed, because a lot of times those student loans are happening in the semester in which that tuition is being borrowed. And so if you say student loans but you don't say future student loans, so let's say you gave someone a 24-month runway to refinance, which is not uncommon right now with people wanting to preserve that 3-4% interest rate. So your sophomore in college now has 4 new student loans that didn't exist at the time that you wrote your settlement agreement. Well, even if there's no payment due, we still have to use a qualifying payment to qualify. So if the settlement agreement wasn't so precise as to say, and future student loans, then, and how about this? Leases. We see it all the time. People co-signing the lease or just signing the lease in general. Well, we have to count that in your debt to income ratio. So it needs to be also addressed in the settlement agreements. When we get involved with you and we're like, how old are the kids? 16. How long are you giving her to refi? 36 months. Are they going to college? Who's going to be responsible for that debt? We can kind of help you guys think through that and be forward thinking instead of having to backpedal and go back to court.
Yeah. Some very easy tips that you can get incorporated into your agreement that make a big difference.
Absolutely.
Tammy, do you have anything to add to that?
No, I think that covers it. I mean, I think the more detailed you can be, the more you can eliminate having to do any post-divorce recovery of, things that you agreed to or forgot. You can't be too detailed, I don't think.
I think a lot of people have privacy concerns about putting things in agreements, and there's a couple of solutions to point out. You do want to be as specific as possible, for sure. You can put the last 4 digits of the accounts that we're talking about, and that should definitely be saying Bank of America, Visa ending in, that shouldn't compromise anybody. You can also do a side agreement where your settlement agreement references it, but it's not filed with the clerk, so people can't go read your information, but it's a legally binding document. You could have full account numbers, more details about the house that you don't want everybody reading, and that you guys are fine with side agreements as well, correct?
Absolutely. And a lot of times, if you're selling the home, you really need that side agreement, because if you have a clever agent, they'll go out and pull it and they'll say, this is the divorce situation, and we know what they have to sell the house for. So, and we know how many days they have to sell it. So we're going to lowball them. We know what the bottom line is.
Yeah, and I've seen that. The parties had a reduction schedule. Every so many days they would reduce the house a certain percentage, and it was in the public record. I came in after the fact, and an agent had pulled it and lowballed them, and they, under the terms, they had to accept it because it was within a certain percentage of asking.
And what a disservice to that divorcing couple. I mean, it's just so
there's ways to create divorce success when it comes to mortgage and real estate. Just ask the proper people. Tammy, I know something that you're passionate about is planning for long-term financial impact. A lot of people don't think 5-10 years down the road.
I think it's really important and something that I personally experience, so I am passionate about it, and that is understanding everything that you're signing up for. It's just not a mortgage payment. If you're signing up for a piece of real estate, you need to consider that there's going to be maintenance items to keeping that piece of real estate up to date, and things that I know a lot of times people want to keep the home because of stability, they're in the same community. There's so many reasons, right? But making sure that you're not going to be house poor, and making sure that you're taking into consideration what your budget needs to be post-divorce, and that, that does include maintenance items, and that does include things that you're going to have to do around the house that maybe your spouse did, that that you didn't have to pay for. Now all of a sudden you have to pay for. I live in Illinois. I mean, there's snow removal, fall cleanup, gutter cleaning, all of these things that not necessarily my spouse did, but now I have to pay for them on my own with my own bank account. So that is really where I personally got into trouble on trying to keep and maintain the house.
Yeah, we replaced an AC unit this year, so do not underestimate future home expenses.
Right,
I think we have
right.
another one on the horizon.
Well, that brings up a good point, Tracy, in that, when people call and say, well, I want to keep the house, I'm going to do an equity buyout, typically one of the first things I ask them is, have you had a home inspection?
Yeah.
Mm-hmm.
Because a lot of times, especially if you've had a marriage that's failing for years and deferred maintenance, just a blind eye is turned to it. And it can be extremely expensive if you have an HVAC that's at the end of its life, or you need a new roof, or you have roots growing up through your driveway. It is concrete resurfacing is no joke. I mean, so those are some serious things that you need to consider before you go to mediation, before you make an offer.
Yeah.
Right.
I think I see a lot where sometimes the person getting the house as well, like everybody understands getting an appraisal, and that's, you don't go on Zillow, have a professional come out, look at this, give a real value. And sometimes the person getting the house is trying to show that, it's not worth as much as they're saying because, of the AC unit, or we have this crack over here. And really the only way to prove your position and the value of that, or the decreased value of the house, is with a home inspection, which isn't incredibly expensive. A few $100s, people get them, when they're buying a house, but you can call a home inspector during your divorce and have them come out and line item these things. Like, yes, it's worth this much, but this AC unit's going to be out in 2 years, or the hot water heater, or all the other issues that come with home ownership. And that's just a really good thing to be doing in conjunction with assessing a value on the home.
Appraisals do not address any of those things unless it is glaring, holes in the wall, missing flooring. I mean, you rarely ever are going to have an appraiser weigh in on whether or not an HVAC needs to be
They're not qualified. The inspector is the one who's qualified.
Right.
So I think that's important as well to, use the right person for the job. But yeah, when I have clients saying, oh, it's not, this appraisal is crazy high because of these defects with the home and maintenance and XYZ, it's like, all right, well, let's take this next step here.
I always tell people that it's like they're buying their own house again. Is it this house that you want? Because that's basically what you're doing, whether or not you're giving up other assets or giving up your spouse's portion of the equity. Is this the house that you want, or is this the time that you need to hit the reset button and start fresh? Right, and maybe right size your budget and right size, because even if you're in a large home, you have to take into consideration it usually comes with large taxes and large maintenance and large everything, right?
Homeowners insurance.
Homeowners insurance, right.
You got to deal with your HOA and all that other kind of stuff. So I think that's a really good point. Would you buy this home again? Because that's what you're doing.
Buy it again?
Would this be your
right.
choice? Or would you like something a little different, down here and different, and not with all these, issues that you're pointing out. So many great tips today. I think that everybody listening is hopefully taking away some great information. If you need to read more about this, you absolutely can read chapter 55 in our book, Divorce Amicably, Your Roadmap to Resolution. You can also reach out to Jennifer and Tami. They have lots of resources and content and articles and all kinds of things, and can also help you personally in making the right decision. Jennifer, if somebody is listening and they want to reach out to you, what is the best way for them to reach you?
The best way would be to go to my website. It's www.jenniferbbrown.com. All of my contact information is there, my email, my phone number, all that good stuff.
All right. And Tami, what about you? How can people reach you?
Really trying to focus on my YouTube channel, so it's Empowered Uncoupling, and it has all of my contact information as well as on my websites.
That's wonderful. And if you're driving and you're like, I'm not able to write any of that down, just save this episode, and their contact information will be in the show notes. You can also find them at amicableDivorceNetwork.com, divorceamicably.com, and if all else fails, send us an email, info@amicableDivorceNetwork.com, and we will put you in direct touch with them. Thank you for all that you do to help us help divorcing clients keep the home, sell the home, but at a minimum, make the right decision.
Thanks so much, Tracy.
Thanks for having us.
It's done. It's just processing.